If you've spent any time looking into investing, you've run into two terms constantly: ETFs and mutual funds. Both are ways to invest in a collection of stocks or bonds. Both give you instant diversification. Both are widely available. But they work differently. They cost differently. They're taxed differently. And for different types of investors, one is clearly better than the other. Today we're breaking down the difference between ETFs and mutual funds in plain language and cutting through the confusion so you know exactly which one makes sense for you. Let's start with what they have in common. Both ETFs and mutual funds are pooled investment vehicles. That means instead of buying individual stocks, you buy a share of a fund that holds many stocks. When you buy a mutual fund or an ETF that tracks the S&P 500, you're getting exposure to 500 companies in one purchase. Both give you diversification. Both come in index and actively managed versions. Both are regulated and widely used by millions of investors. The similarities end there. Now let's talk about how they're different. Difference 1: how they trade. Mutual funds trade once per day after the market closes. You place an order to buy or sell. The transaction executes at the end-of-day price called the NAV, net asset value. It doesn't matter when during the day you place the order. Everyone who transacts on the same day gets the same end-of-day price. ETFs, exchange-traded funds, trade throughout the day on stock exchanges. Just like a stock, you can buy or sell an ETF at 10 a.m. or 3 p.m. and you get the price at that exact moment. For most long-term investors, this difference doesn't matter much. You're not trying to day trade. You're holding for decades. Whether you transact at the end of day or mid-morning is irrelevant to long-term outcomes. But for investors who want more control or flexibility, ETFs offer more. Difference 2: minimum investments. Mutual funds often have minimum investment requirements. Vanguard mutual funds historically $1,000 to $3,000 minimums for some funds. Some actively managed funds $10,000 or more. ETFs you can buy as little as one share. And with fractional shares as little as $1. For investors starting with small amounts, ETFs are dramatically more accessible. Difference 3: fees. Both ETFs and mutual funds have expense ratios: the annual percentage fee charged to manage the fund. Index ETFs often extremely low. Vanguard VTI 0.03% per year. Fidelity FZROX 0%. Index mutual funds also often very low. Vanguard's mutual fund versions of the same indexes similarly near zero. But actively managed mutual funds significantly higher. Expense ratios of 0.5% to 1.5% or more are common. And as we've established, those fees compound against you over decades. Index ETFs and index mutual funds are both low cost. Actively managed mutual funds expensive. Difference 4: tax efficiency. This one matters more than most people realize. ETFs are generally more tax efficient than mutual funds. Here's why. Mutual funds, when the fund manager sells stocks inside the fund to rebalance or raise cash, those sales can trigger capital gains taxes for every shareholder even if you personally didn't sell anything. You could hold a mutual fund all year and still owe capital gains taxes at year-end because of trading the manager did inside the fund. ETFs use a different creation and redemption mechanism that avoids most of these internal capital gains events. As an ETF investor, you generally only pay capital gains tax when you personally sell your ETF shares. For investors in taxable brokerage accounts, this is a meaningful advantage for ETFs. In tax-advantaged accounts, Roth IRA, 401k, this difference doesn't matter because gains aren't taxed inside those accounts anyway. So which one wins? For most regular investors, particularly beginners, ETFs have a slight edge. Lower or zero minimums. Intraday trading flexibility. Slightly better tax efficiency in taxable accounts. Available everywhere with the same low costs as their mutual fund equivalents. But and this is important if you're choosing between a low-cost index ETF and a low-cost index mutual fund from a reputable provider like Vanguard or Fidelity. The difference is minimal. Both will serve you well. The fund type matters far less than whether it's an index fund or actively managed. An index ETF at 0.03% beats an actively managed mutual fund at 1% every time over long periods. An index mutual fund at 0.04% beats an actively managed ETF at 0.75% every time. The active versus passive distinction is far more important than ETF versus mutual fund. Low-cost index ETF or mutual fund beats high-cost active ETF or mutual fund. That's the real takeaway. Now, practical guidance for different situations. If you're investing through a 401k at work, you get what the plan offers. Most 401k plans use mutual funds. Pick the lowest cost index fund options available. Don't worry about whether they're ETFs or mutual funds. If you're investing in a Roth IRA or taxable brokerage account, you have full flexibility. At Fidelity, FZROX and FXAIX are zero-fee index mutual funds. Excellent choice. At Vanguard, VTI and VOO are extremely low-cost index ETFs. Equally excellent. At Schwab, SHB and SHX are solid low-cost index ETFs. All of these are functionally equivalent over long time horizons. Pick the platform you like. Pick the lowest cost option available. Invest consistently. One more thing worth addressing: thematic ETFs and leveraged ETFs. The ETF structure has been used to create some products that look like investing but are closer to speculation. Thematic ETFs funds focused on narrow themes like cannabis, metaverse, electric vehicles, space exploration. These are highly concentrated, subject to hype cycles, often launched near the peak of whatever trend they're targeting. Most underperform simple broad market index funds over time. Leveraged ETFs funds that amplify daily market returns by 2x or 3x. These are not long-term holding vehicles. They experience severe decay over time due to daily rebalancing math. They can lose enormous value even if the underlying market recovers. Not for regular investors. Not for long-term portfolios. Not what we're talking about when we recommend ETFs. The ETFs that make sense for most investors are the boring ones. Broad market. Low cost. No leverage. No gimmicks. VTI. SHB. Say. SROX. Total market or S&P 500. Index-based. Expense ratios near zero. Simple. Proven. Effective. The difference between ETFs and mutual funds is real, but for most long-term index investors, it's not the most important decision you'll make. The most important decisions are: am I investing consistently? Am I in index funds instead of high-cost active funds? Am I leaving it alone long enough to compound? Get those three things right, and whether you're in an ETF or a mutual fund becomes a footnote. Hit like if this cleared up the confusion. Subscribe for the rest of the series. Low cost, broad market, consistent contributions. That's the whole game. See you in the next one.